Hey listeners, let's talk about revolutionizing your mining operation with Foreman. This isn't your average management tool. It's an all-in-one solution for reducing costs and significantly boosting your revenue. Foreman brings a cutting-edge dashboard to your fingertips, empowering you with automated energy strategies. This means not only curtailing around real-time prices, but also strategically enhancing your profit margins through demand response. It's about leveraging energy efficiency to its fullest potential. With Foreman, you get a system that scales with your business, inventory management for assets, infrastructure integration, and business intelligence. Foreman elevates the cash flow and production of your entire operation. To see how Foreman can redefine your mining operation standards, visit foreman.mn. With Foreman, you're not just managing a mining operation, you're setting a new standard in the industry.
Accelerated by Compass is the premier accelerator program for Bitcoin mining sites at any stage of development. Our managed services provide expert guidance in site procurement, construction, energy agreements, and mining operations. Compass helps clients meet timelines and expectations for operational excellence, from greenfield to retrofits and everything in between. Don't just mine, excel. Visit compassmining.io now to discover how Accelerated by Compass can power your success.
Are you a retail or institutional investor interested in Bitcoin mining companies? The Miner Mag brings you free data and analysis from all major NASDAQ-listed Bitcoin mining operations to know who stands out. Check out visualized metrics and data-dependent stories at theminermag.com. Hey, welcome back to the Mining Pod. Today we're joined by Patrick Fleury of TeraWulf. Patrick, welcome to the show. How are you doing today?
Thanks for having me. Doing great.
Well, we set up this conversation, I think, 2 months ago or so. At the time, we had someone on Twitter, part of the Mining Mafia, I think, reach out and be like, hey, you should have TeraWulf on, talk about like their financials. So we went right to the top and got you on board. Thank you for joining. I think for today's conversation, we'll go through like the classic bio and all that sort of stuff. And then I want to move through like the different entities that are involved with TeraWulf, NoWolf, and Talon, maybe some more, maybe some I'm mentioning that aren't important. Give that over to you. And then I want to go through a lot of the different like levers that we speak about when it comes to Bitcoin mining, debt, equity, and Bitcoin, and then finish up with some of the labs that you guys are running on, whether that be like HPC, AI, other coins, etc. So I'll hand it off to you first for like a brief bio and then a rundown on TeraWulf, and then we'll jump into sort of the entity structuring.
Great. Sounds good. Yeah, quick bio on me. I've about 24 years in finance. That's why I don't have any hair, as you can see. But most of that, about 18 years as an institutional investor on the buy side, and some banking experience when I first started my career, and now, the last 2 years as CFO at TeraWulf. And so just, it's probably interesting to note, the team at TeraWulf, Paul, Nazar, Carrie, Stephanie, we've all been working together for probably about 15 years. The team originally, when I was at Blackstone, was my management team running a power portfolio of assets that I put together. And when I left Blackstone, Paul and the team bought the assets back personally. And that's what formed, the basis of TeraWulf. And so when you think about what TeraWulf has today, we mine at 2 sites. The first is in Western Pennsylvania at the Nautilus crypto mine. That's a behind the meter site of one of the nation's largest nuclear facilities that we are JV with Talon on. And then we mine at Lake Mariner, which is our upstate New York site, which is about 25, 30 miles east of Niagara Falls. So that facility is 200 megawatts. Combined, both facilities are about 10 exahash now. And largely, I think we're 95% zero carbons. We're mining from Niagara Falls, which is hydroelectric, and the nuke, which is all zero carbon. So that's a quick story about who we are, what we have going. We have a lot of expansion potential, frankly, at both sites. The Nautilus site can only be Bitcoin mining, and then the upstate New York Lake Mariner site can be Bitcoin mining and or high power compute and AI. And we've got the ability over time to expand that site up to about 770 megawatts. So a lot of room for expansion to go. So that's a quick summary of who we are.
Awesome. So it's good at the entity stuff, and you kind of mentioned it a little bit there as well, but you guys have a relationship with Talon, if I'm not incorrect. And then there's a few other like entities involved. And I'd say like the premise for this question is I've seen like a lot of different charts of like different entities that have an interest in these various companies. And at a certain point, I was like, okay, I can't investigate this more. I'm just going to ask them straight up. So like, if I am a shareholder in TeraWulf, what are the entities that I should care about or would be important?
Yeah, look, I think that's exactly the right way to think about it. So TeraWulf, right, is the public company. And there's a couple of different relationships. So let me explain them. So the easiest one is NovaWulf. There is zero relationship with NovaWulf. NovaWulf actually doesn't really exist anymore at all. So that's a really easy one. At one point in time, NovaWulf was competing for Celsius. It lost that, and then NovaWulf was effectively disbanded. So NovaWulf has nothing to do with anything we do. So that's the easy one. There's only about 9 employees of TeraWulf, and that is really the executive suite. All the other employees that a public company typically would have are billed to us from Beowulf Electricity and Data. Beowulf E&D, as we refer to it, is owned by Paul Prager, our CEO and founder. And all of the folks that support me, so on the audit side, on finance side, all the folks that support our legal department, that support our regulatory and political affairs, they are all employees of Beowulf Electricity and Data that are billed to TeraWulf at cost. So that's why we only have 9 employees of TeraWulf, and the rest comes through Beowulf E&D. And you can see that if you look at our financial statements, you'll see SG&A, related party, and other operating expenses, related party. So that's the portion of our SG&A and our operating expenses that are effectively billed through Beowulf Electricity and Data, not just directly through TeraWulf. So that's really how that works. Like I said, it's done at cost. You can look at our SG&A and our SG&A guidance. I mean, I think we have among the lowest SG&A in the Bitcoin mining space. Our guidance this year is about $28 million. And that's really the cost to run the public company and all the people that, again, support us through Beowulf E&D. So that's kind of the relationship there. And then with regard to Talon, that's now a very simple relationship. We have a JV with them at Nautilus. We own 50 megawatts out of 200. So they own the other 150. And we buy power from Talon. Right now, that contract is a 2-cent power contract for 5 years. That contract runs through the end of 27, so first quarter of 2028. And the only difference now is we used to make lease payments to Talon. Talon sold the site to Amazon. And so now for both Talon and us at the Nautilus crypto mine, our landlord is Amazon. That lease runs through 2033. And so that's, just generally how that arrangement works. The only complicating factor for TeraWulf, as you may know, which has been very frustrating for me as a CFO, is because we own 25% of a JV, we're not permitted to consolidate Nautilus in our GAAP financials. So instead, Nautilus comes through our financials in one line item called equity and net investee. So that's frustrating just because folks look at it and will do quick math and conclude that either our cost to mine Bitcoin is higher than it should be. The reality is we cannot put Nautilus in our revenue, in our costs. It has to all kind of come through that line. And so what we try to do in our monthly operating reports and our adjusted EBITDA that we report on a quarterly basis is kind of break it out so you can see what Nautilus is actually contributing. But we just cannot, GAAP doesn't permit us to consolidate it.
Gotcha. Well, no, that's a great segue to the next topic. I was watching you on another show, I think like 3+ months ago. And you kind of talked about how your background as CFO has nothing to do with Bitcoin mining, but you've been working with Paul and Nazar and others for quite some time. I'd just be curious, what was the transition into Bitcoin mining like? And also talking a little bit, you're laughing there, which is funny. So I'm sure there must be something there. What about the financial side? What should we be paying attention to as maybe a regular shareholder, or there's even a lot of actually CFOs or people who work in financial departments at these Bitcoin miners. what would be some insights that you'd speak to them if you had 15 minutes for a coffee chat with them?
Yeah, look, so there's a bunch of pieces of that question. So let me break it down.
Yeah.
So yeah, I mean, my entry, like I said, I was 18 years on the buy side, and I never, ever, ever wanted to be a public company officer. It was like literally the last thing on earth I wanted to do. And, I came in, I've known Paul Nazar carry the team, like I said, for a very long time. And they were fortunate enough to take TeraWulf public in the, bull market. And that was sort of the fortunate and the unfortunate part, because it came public really on a business plan. There was basically no operations. And when it came public with a $3 billion valuation. So they had assumed, they could kind of use equity with an eyedropper to finish the construction and the build out. And then the market quickly turned, and they found themselves in a situation where they had too much debt for the Bitcoin environment that they were in, and they still needed capital to kind of finish the sites. And so, they turned to me, and I came in and negotiated a number of amendments with our debt holders, many of which, I've been investing with together with for about 18 years. So that process, I think, was easier because I trusted them, they trusted me, and I was inside the company and really explaining to them just the facts. And so we were able to kind of get to, I think, a really good place where they took some equity upside in the company and changed our fixed amortization schedule to one that allowed us to use free cash flow. And so that really saved the company and allowed us to get a financing done, allowed us to complete all of our facilities, and that it's been kind of, it's just been a great turnaround story ever since that. And so, yeah, look, it's, the way we position TeraWulf, I was a commodity investor for 18 years. So we give guidance and show our results like any other legitimate commodity business I've ever invested in. I mean, this is, when you break it down, like Bitcoin mining, it is a super simple business. Your number one input cost is power. That determines where you are in the marginal cost curve. And then you literally have two other expenses. It's site level folks and SG&A. That's it. We have one more because we have debt, but we will soon be debt free. So we have interest expense, but literally it's only three expenses. And so to me, coming into this space and seeing companies and management teams not disclose what their cost to mine a Bitcoin is, I mean, that would be like if Valero didn't tell you what their cost to refine oil is, or ExxonMobil didn't tell you what their cost to get, oil out of the ground. I mean, it's just preposterous. So to me, in my career, any management team that's not willing to answer the question, or a CEO or CFO of what's your cost to develop the commodity you're in, either they're stupid, right? Which I have seen sometimes in the past, and they don't care, or B, they don't want to tell you because it's so bad that they know you wouldn't want to be an investor. And I think, there's a lot of management teams in this space. I don't think they're stupid. I just think they don't want to tell investors what their cost is. And what shocks me is that people still own those companies because, again, if they're not telling you for a reason. It's because they don't want you to know. But I think what I'm like really looking forward to, and I think it's going to be really ugly, is when folks post second quarter results in early August, it is going to be a train wreck for a couple of big miners, because it's going to show you that they make zero money mining Bitcoin, which is supposed to be their primary business. Not only that, but they're losing money in today, right, post-halving, and they're diluting shareholders by issuing hundreds of millions of dollars of equity so that they can stack Bitcoin. To me, stacking Bitcoin, I think if you're a profitable mining business, that's a legitimate strategy. And if you want to sell some Bitcoin to pay for your operating costs and stack the rest, that's your prerogative. I think that frankly could end up being a really good strategy in the long term, right? But that's different than like a micro strategies. Like Michael Saylor and like the sort of, mousetrap he's designed is he can borrow at virtually nothing, zero cost, and own Bitcoin. So he's borrowing in fiat to own Bitcoin. Like that makes a ton of sense. But he's not losing money on his existing mining business, right? He doesn't have a mining business. If you're losing money on your mining business, stacking Bitcoin and diluting shareholders, like the music ultimately is going to stop there, because if you're an investor in that company, you should just go buy the Bitcoin ETF. That way you're not going to be diluted and you can just hold Bitcoin for as long as you want. And so that has really kind of been something that's bothered me in this space, because I think, look, retail investors are very sophisticated, but some of them are not as sophisticated as institutional investors. And so I just think there's a couple big companies in the space that have really been doing a lot of us a disservice because they're not viable business models long term. And so I'm excited to see second quarter results, because I have a saying that, that I share with folks internally: numbers don't lie. Management teams can go lie and they can sort of avoid questions, but when you file your results, you can't hide from that. And so I think second quarter results, particularly because folks aren't going to be able to mask their earnings by marking their Bitcoin higher. It's actually going to be a mark down. So you're really going to be able to see, I think, are people making money in their fundamental mining business? And I can tell you, our fully loaded cost mine post halving has been around 40,000 a Bitcoin. And so we're mining, somewhere between 6 and 8 Bitcoin a day. And Bitcoin's been on the screens, other than this last dip at, call it 60 to 70,000. So we're making kind of 20, 30,000 Bitcoin of true profit on every Bitcoin we're mining daily, right? And that's like, as an investor, whether you're retail or institutional, that's all you want to know, right? And anybody that doesn't tell you that, I personally would not invest, because I think their company's probably losing money.
I want to go back to the energy thing and then come back to the portion you went off on there about, which I absolutely love. So for the energy side, like maybe a devil's advocate for not disclosing what your energy or your all-in rate is, there's competition in the space, and you don't want to show people your hand, right? So like maybe the one that comes to mind, this is a private company, so it's not super fair, but Swan Mining came out of nowhere. They were kind of building up their own fleet, and they launched with like 7 exahash. Tether's been putting money into them. Tether's been investing in the space very heavily. Again, these are all private companies, so the example's not very fair. But if you're one of them, look at that playbook, they are trying to be kind of silent and quiet and eke into these places where other people aren't. And I think maybe there's some sort of parallel there with public companies who aren't always disclosing maybe monthly their energy costs. Maybe they only do it quarterly when they have to with the SEC. I certainly agree that there's like a lot of teams who do not disclose correctly their all-in energy rates. Like they play a lot of games with the numbers to make it look a little bit better. But do you think there is a devil advocate position for why you want to disclose all your information?
No, I think that's total garbage. And to excuse my French, complete bullshit. It's just not like to say it's a competitive advantage or just the reality is you have your sites now, and you either have good power, like low price power, or you have bad power. Yeah. Like the reality is, like at Blackstone Investment Committee, we used to have a saying: bad company, bad balance sheet, not fixable. Yeah. Good company, bad balance sheet, fixable. In Bitcoin mining, bad power, not fixable. You will always be high on the marginal cost curve.
Yeah. Good
power, you're always going to make money because that's going to make you the lowest marginal cost producer, period. So that I do not buy for 1 second this argument that, your power cost is proprietary and somehow, like it doesn't make a difference. The reality is you're either located in a good location on the grid where there's an abundance of low cost, low priced power, or you're not. And the reality is, as we all have seen, people ask me where Bitcoin price is going to go. And I say, I have no idea, because if I did, I wouldn't be sitting here talking to you. I'd be, retired doing something different. But what I do know is I can control my cost. Yeah. And my cost can be controlled by trying to minimize my number one, my power costs. Like every penny makes a huge difference, particularly post-halving. And then the total cost to run my business, which is SG&A, right? That's what I can control and what I am focused on. The rest of it, right, wherever Bitcoin price goes, it goes. But the reality is, right, if you have bad power, it's never going to fix itself because, as we know, Bitcoin price goes to 100,000 or 200,000, network hash rate's going to follow. Yep. So your marginal cost is going to stay high. And so That's why I come back to, Will, like, I think anybody that's not willing to disclose on, and particularly on like a quarterly conference call where an investor directly or a research analyst directly asks you, what's your cost to mine? And someone doesn't answer, I would sell that stock immediately.
I love the energy on this one. Let's go to the ATM question really quickly. So your last point there before we talked about energy was about how a lot of teams are diluting to be able to hold Bitcoin on their balance sheet, which happened in 2021. It's a lot of the same playbook, right? Like that time it was all about the HODL meme, and there was like Bitcoin Magazine was tweeting out every time a Bitcoin miner disclosed that it had added more to its monthly HODL. I think it was almost a marketing play at some point just to add more people to like their roster of shareholders. That didn't work out during bear market, and that came really hard and fast, and a lot of people found themselves underwater. However, it doesn't seem like you guys are against using ATMs, right? So correct me if I'm wrong, but like the research I showed was like you guys did 77% dilution this year in terms of share creation, which we've talked about a lot on the show. ATMs make a lot of sense. But I just wanted to like get back to that question. Where does it make sense for a Bitcoin miner that is making money profitably on every Bitcoin they mine to use the ATM?
Yeah, look, it's a great question. And yeah, look, our dilution of this year, to be fair, like a lot of that really like last year and this year was because we needed that amendment from our debt holders, and that cost us, dearly with dilution. But look, I think we own collectively as a management team, board, and insiders, we own 30 to 40% of the equity of the company, which is unlike any other Bitcoin miner out there, right? So look, these businesses, right, to establish a business, we had to grow, and the only way really to do that was through equity. So that's what we've done. But I think once you get to a certain critical mass, right, because there are economies of scale in Bitcoin mining, but we definitely do not subscribe to the growth at any and all costs perspective that some of our peers do. And again, I think if you're growing, if you take a company like a CleanSpark or Cypher that have a low cost of power, that makes sense to grow because they are profitable and they're using free cash flow and combined with equity dilution to grow. That makes sense. And so scale can help that. But there's certain companies that like, it doesn't matter if they're 50 exahash or 5, I'm still going to be more profitable as like a fifth of the size. Like that to me doesn't make any sense. Like why grow if your profitability is never really going to be the same as like mine? So where the way we think about dilution and where it's accretive is not based on like valuing businesses on like enterprise value to exahash, because that doesn't take into account profitability. So for us, it's what is our EBITDA multiple? And, is when I run an NPV of buying a new miner, right? There's a couple inputs. What's the cost to buy the miner? What is the price of Bitcoin? And what's the price of power? I know the cost to buy the miner and I know the price of power. So I'm playing around with what do I think basically Bitcoin price and network hash rate are going to be. And we won't pull the trigger unless that NPV is very, very green, like positive, right? And we have got a lot of room for margin. And so that we've kind of thought about it on both an NPV acquisition basis and also on an enterprise value to EBITDA multiple basis of where is it accretive to issue equity or not. Now, we also happen to have debt, and I think issuing equity, which we have done some of to pay down debt, is accretive for us because A, we have a maturity later this year, and B, it's 11.5% coupon cash pay debt, which increases by a couple $1,000s per Bitcoin my marginal cost to mine. So really, when I think about equity for us, it's yes, there's repayment of debt, which is accretive. And then there's also like, where do we trade on an enterprise value to EBITDA basis? Do we think that's a good multiple? And all of that combined with what is the actual NPV of the miner that we're buying and plugging in? So I think that tries to answer your question, frankly, 3 different ways.
In the competitive world of Bitcoin mining, one name stands out: CleanSpark, America's Bitcoin miner. At CleanSpark, efficiency isn't just a goal, it's our standard. Our sophisticated facilities are built and led by expert teams who care about Bitcoin and the communities we work in. Scale, we've mastered it. Our large-scale operations have set us apart in the industry as examples of community-oriented building. Our track record speaks for itself. We navigate the complexities of the new economy with precision and with skill, continuously achieving operational milestones. Curious about how we do it? We invite you to discover the story behind CleanSpark's success at cleanspark.com.
Something we've talked a lot on this show about with many miners, many CFOs at other companies as well, or C-suite at the very least, is like you have 3 levers, right? You have Bitcoin, you have equity, or you have debt. Debt kind of went off the table for a lot of people just because of high interest rates. And those interest rates moved up so fast in 2021, 2022. Equity became a little more difficult during a bear market where people don't really want to use ATMs as much. Obviously, during bull market in the last 9 months, we've seen some crazy ATMs. And then the Bitcoin offering, like people started selling. I think everyone sold at last cycle. And there's even like some things that were further off the table were like loans using ASICs as collateral or using infrastructure as collateral. That went off the table as well because all those deals kind of blew up last cycle. And so they still exist, but they're harder to find. So I always find like people who are running within your role have kind of, not to be unfair, but like kind of a terrible task because you have to like work with all these different inputs that are difficult to balance against each other. And then every time you make a decision, whether it be debt or equity or selling Bitcoin, someone online is going to be unhappy about it. One metric I'd be curious to get your take on is one that actually Zach Bradford at CleanSpark brought up on this show. I think it was the depth of the bear market. It was like December 2022, maybe a little bit after that. And they had just done an ATM or announced doing an ATM. And he talked about on the show the value of issuing equity at a terahash value, terahash ratio. So they want to issue equity at a value where they're able to purchase a certain amount of terahash, and they want to keep that ratio all the time. So even during a bull market, they want to keep that ratio. And I don't really just want to make you opine on that topic, but what are some other sort of metrics that you look at as a CFO that's like, and this is kind of our golden ticket? You mentioned a few already there, but some that come to mind are like revenue per employee. You mentioned cost to mine Bitcoin, things like that. The EBITDA ratio you mentioned. But
I mean, I would add, look, I think if you look at our investor deck from the first quarter, you know, we put a bunch of new multiples in there, that the ways we look at things. So like EBITDA to exahash, right? Measure of profitability. And by the way, I think EBITDA, like adjusted EBITDA, which pulls out any mark to market of your Bitcoin stack. So it's like, what's the true profitability of your mining business? So that's one that, you know, I look at all the time. Look, I think the rest of it, like I like Zach, I think, and Gary, I think they do a great job. I think they're very profitable mining business. But I don't think we subscribe to that sort of scale at all costs mentality.
Yeah.
Like, you know, I'd rather get to a place where we're very profitable and we're debt free, and I can allocate capital depending upon cycles. So like, for example, if the stock's really cheap, I can buy back stock. If I don't think the stock is that cheap and there's not really interesting growth to do because that NPV analysis isn't really green, then I'll pay a dividend. Maybe I'll pay a dividend in Bitcoin and or cash, right? So I don't, the concept, you know, and I've heard other folks talk about, well, you got to grow, keep your share of the network hash rate, right? Like I'm like, that doesn't make any sense to me either. Because again, like if you're profitable and you can fund that growth accretively, great. But just to say, oh, I want to keep like my percentage, like that just, again, that's something, in my opinion, somebody made up so they can justify growth. I mean, ATMs in this space, right, have been, as you've seen, I'm just shocked at the amount that folks can issue on the ATM.
Yeah.
We had one ATM originally when the company came public for 200 million.
Yep.
A couple months ago, we reloaded that by 200 million. Many of our peers have filed 500, 700, 800, 1.5 billion ATMs. And not only that, but most of those companies have double or triple our SG&A. So, and they're not as profitable as we are. So you have a scenario where companies are basically issuing hundreds of millions, paying their management teams like NBA players, whether they make money or not, and then just stacking Bitcoin on their balance sheets. And so back to your point, like, again, I love Bitcoin. I think it will be ultimately much, much, much higher priced. But let me ask you a real question. Do you think the management teams that are not making money mining Bitcoin and stacking BTC on their balance sheet, do you think even if Bitcoin runs to 100 or 200,000 that they're ever actually going to sell that Bitcoin or do something productive with it? Because think about it, right now, it's just an asset that's sitting on their balance sheet, being underutilized. And so I just want to come. So you had mentioned, and I think this is a really important point, different ways to fund companies in this space, right? So I spent a lot of time in oil and gas.
Yeah.
I think where this space will ultimately go is you'll see debt come back in, but it'll be debt at a corporate level where once the counterparty collateral market is more sophisticated. And what I mean by that is, when I was on the buy side, we have prime brokerage accounts. So you got a prime broker with JP Morgan or Goldman Sachs or whomever. And that prime broker, you have an ISDA or multiple ISDAs with, which allows you to trade. You can do options, derivatives, other things, right? And you can kind of offset risk here and there in your book. Nothing like that exists for me as a public Bitcoin miner. What I mean by that is, wouldn't it be amazing if, like Coinbase, as an example, I could custody with them, I could do all kinds of derivative trades with them, and I didn't have to basically move stuff around to multiple counterparties that I get really nervous with. And not only that, but in trades, counterparties have a right to my Bitcoin. So I kind of lose control of it. And so my point to you is, I think this industry is getting more and more sophisticated and will ultimately end up in a place where, like, a Coinbase is effectively my prime broker. And I can go out and do hedges and derivatives with them because that market actually is quite robust. You go look at Deribit and you're talking like tens and hundreds of millions of dollars of option volume every day. So it's deep. The market is there, but there's just not an efficient, I don't want to say risk-free, but relatively risk-free way for me to effectively take on debt like an oil and gas company with at a corporate level and then hedge like oil and gas companies do. So once I can do that, then I think you'll see debt come back into the space where management teams will have like 1 to 2 times leverage, right, as a tool in the financing toolkit. So moderate leverage on a big business, right? That makes a lot of sense to me. But the reason I don't think you're going to see that quite yet is that sort of prime brokerage market for Bitcoin miners has to develop to the point that, like, I'm really comfortable with the counterparty risk I'm taking to hedge out my effective production to cover my interest expense. And then I think you'll see that kind of debt tool come back into our toolbox.
Just one quick clarification. Do you think ATMs are still going to be more attractive in that case, though? Just because it seems like people just issue them, they get a little flack, and then they are oversubscribed and sell out. I mean, like, most of them have done really well.
Yeah, I've been shocked at that. Look, I think I would say as the investor base gets more diverse from retail into institutional investors, I think institutional investors will hold management teams to a higher standard. And I think you'll see as that transition happens, probably less use over time of the ATM.
Yeah. Because
I think institutional investors just demand a different type of disclosure and performance from a company. And so, I think if miners want that stock, those holders of institutional holders of stock in their companies, I think that's going to require some change.
The last thing I'll note is like maybe there is a world where there's better ways to use Bitcoin as working capital and increase that capital efficiency in the next 5 to 10 years. So I do think between those three things, like we've touched on, like better debt strategies through use of corporate debt and hedging strategies internally, using your Bitcoin as working capital, and then maybe more responsible ATMs, or there is some like great tools coming up. But for right now, it just seems like dumping on shareholders is like the prime way of using money, and then spending on marketing, which I'm not super opposed to as a podcast, but it is something that we'll use. Let's go to the lab section of your company. We've had Nauzer on the podcast actually discuss this with a project that he personally invested into, a GPU project that is working with zero knowledge proofs. And you guys have, I think, a few of like their test ASICs on one of your labs. But I'm curious about some of the other projects you're working on. If you could just review them for me, that'd be great. And if you have them off your top of the head, but I know there's like some HPC stuff you guys are working on, HPC and AI. There's some other token projects you're looking at, and there seems to be some stuff with energy as well.
Yeah, sure. So maybe let me just review kind of what we have at Lake Mariner, and that'll explain kind of our strategy there. So that site's a former retired now coal plant site. The coal plant was 700 megawatts, and all the electrical infrastructure on the site was designed for 770 megawatts. So we actually have a substation and switchyard at the site where we have dual redundancy, meaning we have two 345 kV transmission lines coming into the site. Each one has a transformer. And so we are able to, like, if we lost one of those lines, we would just switch to the other one. That's very rare. Okay. But and you'll see in our marketing materials, we kind of guide folks to 500 megawatts. The reality is we can go up to 770, but from a timing perspective, we have the ability today to take 250 megawatts. We will have the ability, because we've been sort of in the queue awaiting the approval, which we think will come in the first quarter of next year, to take another 250 megawatts. So we have the ability to take 500 megawatts of power off the grid. We then, once we have a line of sight to that 500, we will then go back to the local utility, National Grid, and the New York ISO, request a transmission study. And we think order of magnitude have to fund $10 to $20 million of transmission upgrades, which will take 12 to 24 months. And then we will be able to take, if we want, up to the full 770 megawatts. So we have 200 megawatts of Bitcoin mining at the site today. So that is effectively another 570 megawatts of unused power that we will be able to take in the future. And so what our focus today is, we've been running a high power compute AI pilot at the site for about 9 months now. We just recently announced in our June operating report, we're working on roughly a 2 megawatt, call it GPU as a service pilot. So you will see us, I think, in a very small way, I'm talking in like single digit millions of dollars, own and operate some of our own GPUs to understand that business more. But then primarily what we're focused on, and we're starting with our first 20 megawatt building, which will be ready at the end of the year, is co-locating customers similar to what Core Scientific and CoreWeave are doing at our site. And then really for the next, call it 300 megawatts of immediately expandable power, looking at, legging into that with one or multiple high power compute AI customers, and really doing the co-location model, which you'll see on kind of page 14 of our investor deck from the first quarter, is very similar in economics to what Core Scientific and CoreWeave recently announced. So that's kind of where we're driving use of those megawatts in the future. That obviously, as again, a long time buy-side investor, the Bitcoin mining business, in my opinion, is kind of like a refinery where I think it should kind of trade sort of maybe 6 times EBITDA to 12 times EBITDA peak to trough. Entering the high power compute and AI business, you can look at public companies like Equinix or Digital Bridge or Digital Realty or others mean, they trade at 20 to 25 times EBITDA. And so that business for us, we think, just on that incremental 300 megawatts of capacity we have in the near term, we think that's like a $5-6 billion valuation or value creation opportunity. And that's, something we're very focused on. So yes, so I think you'll see the 2 megawatt GPU as a service kind of pilot, move forward, and then the really co-location again, which is this middle column here that we walked folks through on our first quarter call. That's really what we're focused on for that, next 300 megawatts.
Need ASIC help? Check out Vitamine, one of Bitmain's certified repair shops located in Washington State with satellite offices in Colorado, Oklahoma, and Texas. PSUs, hashboards, immersion setups, in and out of warranty repair, Vitamine has you covered. Want to train your technicians? Bring Vitamine to your site for hands-on training in the art of ASIC repair, complete with Bitmain AMTC certification. Contact Vitamine today at dan@vmasic.com. Again, that's dan@vmasic.com. When you think of ASIC repair, think Vitamine.
Yeah, I found the graphic. Penny Ether shared this on Twitter and is asking about this specifically. I should have shared that when you were discussing for people who are watching on YouTube. But for those listening on audio, which is most of our audience, cloud service providers, co-location, and then built-to-suit for AI, HPC. Out of these three, I'm just curious, which one do any of these like jive with you? Like you're interested in learning more about them or working with them, or is it just like all numbers to you and you're happy to like work with whoever is going to bring the best to the balance sheet?
What I really like, so just kind of starting from far right to moving across the page, right? So the build to suit, and I think now that we know what we know, which is a lot more than what we knew even a couple of weeks ago, I would call this more like PowerShell. And this is really more your hyperscalers. So it's your Microsoft, Google, Meta, Amazon, Oracle, right? That's kind of what those folks want to do. And obviously, like working with those folks and talking with them, I mean, they're all tremendous companies, right? You don't get to be sort of a Magnificent Seven company without being really good at what you do. So, that's kind of that column. The middle column is more of your CoreWeave, OpenAI, xAI, Lambda, you're sort of mostly private companies, but that have substantial valuations that are trying to compete with the hyperscalers. And that's where, we see a lot of value, and obviously Core Scientific does too. It's funny, a lot of people, I've probably done over 100 investor calls in the past 3 weeks, right? Since CoreWeave and Core Scientific announced their deal. And a lot of folks will ask me, hey, were you surprised by the deal? And I say, no, not at all, because this page that you're looking at, I put out weeks before they announced the deal. So, and they, by the way, they hit the middle column here, like right on the screws. Their deal literally is like right here. That being said, there were two things in that deal that surprised me. One was the timing. It came quicker than I expected. And that's, I would compliment Adam Sullivan and his team. They had the vision to work with CoreWeave, far ahead of anybody else. They've been working with them, I think, for 9 to 12 months already. So that was a great seed that they kind of watered over time, and it grew into something bigger. And the other piece that did surprise me was the fact that CoreWeave is willing to fund all of it. That I think is very unique because, for example, when you think about our site, 300 megawatts, right? That's like $9 to $10 billion of capital to build the whole thing out. There's, I could name on two hands, right, the number of companies in the world that could write that check. I mean, even CoreWeave with a $19 billion valuation like that, right? I mean, they would have to go out and raise a lot of capital to do that. So what I'm trying to do is create a little bit of a different mousetrap where, similar to the CoreWeave Core Scientific deal, you get a 1-year prepay from your customers, which effectively, and that's a 1-year revenue prepay, that effectively functions as my equity. So I don't have to raise any equity publicly. And then I'm trying to go to the project finance markets to finance the other piece, which ends up being kind of like 70 to 80% of the cost of the project. And with a 15 to 25 year type contract, that's doable. And so that's the piece of their deal that I was surprised by. But as far as the economics, again, I wasn't, because we put this down on paper weeks before their deal was announced. So I think, we're really excited about the entry into this business. We think it's going to create a ton of value for us and our shareholders. Mm-hmm. And, like I said, the last column here, this is really like cloud service provider. That's not our business for a couple reasons. One, it's, as you can see here on the build cost per megawatt, super capital intensive. And I'd rather leave that to folks like Microsoft and Amazon and Google and others that have a very low cost of capital. And, we don't. Our cost of capital is better than it was, a couple months ago, but I still, it's just too expensive to enter in a major way. And the other piece is, you're taking GPU technology risk with that strategy. And, based on being in a similar business with ASICs, I mean, Moore's law, right? Efficiency doubles every 2 years. And so while I might be able to charge, $450 a kilowatt hour per GPUs today, like that same thing is I'm going to be able to charge probably $1.50 or $2, like in 2, 3, 4 years. And so that's just not a business I'm in. I mean, we are energy infrastructure DNA. That's what we do best. And so that's why we're sort of gravitating toward this middle column where we take advantage of our expertise, which is owning and operating and building the infrastructure. And then somebody else brings the GPUs and functions as like more the cloud service provider.
Yeah, it's Bitcoin mining, right? You want to own the mine itself, or you want to sell with picks and shovels, but you don't want to be out there swinging the hammer most of the time. So that makes sense.
Correct.
Yeah, I guess I'll just kind of I have a lot of questions about this, so we could probably go on for quite a while, but we'll probably wrap up with this question so we don't dig into it too much more. When you're negotiating a contract like this, how much wiggle room have you seen so far? The reasoning or context behind that question is bull market for Bitcoin, things get silly. I've seen crazy contracts. I know that there's a lot of crazy contracts out there that make no sense. People just kind of, taping things together, stapling them together. In this GPU cloud world, how buttoned up professional is it when most of these contracts are coming together? And then how are you sort of creating that quote unquote mousetrap? How are you constructing that so it's beneficial to both parties or however many parties are involved?
Yeah, great question. So let me just put it into context, okay? Because I've spent my whole career in power commodities. What we're talking about and why we think what we have is so valuable for just a moment. So whether you look at the Energy Information Administration or Goldman Sachs or Morgan Stanley or, pick where you want to get the information from. Generally speaking, we got about 20 gigawatts of data center load in the US today. That is projected to effectively double in the next 4 to 5 years. So we'd have 40 gigawatts, okay, of data center load. To put that in perspective, California is the 5th largest economy in the world, and their power grid is 85 gigawatts. So you're talking about data center load consuming half of the power in the US of the 5th largest economy in the world. On a power grid, mind you, that has grown at about 0.5% CAGR over the last 10 to 15 years. So you're asking a power grid in the US to do something it hasn't done, frankly, since like the Industrial Revolution, which is grow at 4, 5, 6% annualized CAGR. Having spent my whole career in that business, that is literally impossible to do unless the price of power for every single consumer in the US is going to double or triple, right? Which is why folks like Amazon, Microsoft, others are so focused, and Amazon went and bought the site from Talon for $650 million. So when you think about what they bought land and a substation and the right in the future to purchase power directly from the nuke. That's it. So that shows you like how focused these big hyperscalers and other customers are on getting power. Because the reality is that bottleneck used to be GPUs. But now you look at NVIDIA, they did 26 billion of sales in the first quarter. 24 billion of the 26 was to data center clients, and only 4 companies were 40% of all of their sales: Google, Meta, Amazon, and Microsoft. So like, why is that relevant to us? Well, it's because in a couple of years, every single company in the S&P 500 is going to be using AI, right? And so we're only talking about 4 companies right now. We're not even talking about, by the way, United States of America sovereign AI, right? Government AI, like not just us, but then governments all over the world. So the scarcest asset in that entire universe is power and access to power and power infrastructure. Because at some point, right, you can buy as many GPUs from NVIDIA as you want, but if they're sitting in a warehouse because you can't plug them in, then you have a problem. And so when we're focused, right, I mean, our site is very unique. We have access to, like I mentioned to you, 770 megawatts. Okay. I mean, that would make us alone, if we were all data center, we'd be one of the largest data center companies in the US.
Yeah.
And we have access to land and water. We're right on the shores of Lake Ontario with a permit to pull hundreds of thousands of gallons from the lake, right, as the old coal plant. And we have largely zero carbon power because we're 25 miles east of Niagara Falls. So that sort of trifecta, if you will, of zero carbon, low cost, land and water, that just doesn't exist at many sites around the US. And that's why we are so focused on, look, we're not in any rush. Well, I want to be clear. We're not going to retrofit our Bitcoin mine like, Core Scientific just did, because our Bitcoin mine makes money. It's profitable. And if we can figure out a way to do what Core Scientific did in this middle column, and it costs us zero equity, we don't have to fund anything, then that's a home run. Because now I can start, like I mentioned, I can start thinking about, okay, how do we allocate our positive free cash flow once we've repaid our debt? And then I'm in a totally different world, right? I mean, I want to be, I've mentioned this publicly before, but I want to be the first Bitcoin miner that goes the other way and is either paying a dividend or buying back stock and like rewarding shareholders. Because I think as this business matures, we all ultimately have to get to a place where you say, when are you going to stop growing and maximize profits and return profits to shareholders? I mean, that, like any nascent business, you got to get to a certain amount of size, but then at some point, like, you can't just keep growing in a perpetuity, right? You got to start allocating that capital in a different way. And so I think the entry into this business, and I'll come back, I don't know if I answered your question directly. We're kind of in a roundabout way, but I think the entry into this business and having it be co-located at a Bitcoin mine where we can also be very responsive from a demand response perspective and be a resource back to the grid in periods of crisis, we think the combination of those two things is really unique.
Last question, had to throw in there because you reminded me one I've been asking people quite a bit. Who's the first Bitcoin miner that's just going to be completely bought by one of these big giants, Meta, whoever? And then that's kind of unfair because I don't think you're allowed to like publicly comment on that. But I do think it's going to happen pretty soon here. One of these like small cap miners is going to get kind of level just for their energy contracts.
Yeah, look, it's a good question. And maybe I'll do this. Maybe I'll answer it a different way.
Yeah.
I think there's some folks out there that think about sort of profitability in Bitcoin mining and just, I think, lowering costs and, operating what I think are viable public Bitcoin models in a similar way to us. And I would say, I think those are, those are CleanSpark, Core Scientific, Cypher, and probably Iris, right? And so I think when you look at those businesses, again, in the space, because cost of power determines where you are in the marginal cost curve. When you look at who founded the companies, was it power people? Was it not power people? Is it financial people? I mean, in my company, I'm the only financial person. Like everyone else is a literally energy power plant infrastructure expert. Right? I mean, we got folks on our team like Sean Farrell, who was at Siemens for a decade, right? Paul Nazar, who built, operated power plants all over the world for 30 years. Like that is our DNA. And I think other companies that have that same DNA, I think are built to last and be very profitable in Bitcoin mining, but they tend to have really good power contracts and good power structure, which I think is what will lead the hyperscalers like to focus on them first. And look, the other big important thing is renewable zero carbon. I think, as I mentioned, just given the increase in power coming from AI, it's going to be really politically sensitive as to what that source of power is.
Yeah.
Right? Is it zero carbon? Like, to make sure that you're not keeping coal plants or gas plants that otherwise would have retired alive by, breathing life back into them because you're co-locating an AI data center. That's, I think, going to be increasingly important, particularly when you look at like the big hyperscalers, like I mentioned, like Google, Amazon, Meta, Microsoft. I mean, they're already in the antitrust crosshairs all the time. And so now politically, if they're back in the spotlight because of the, driving power costs for consumers up, it's going to be a problem.
Hey, well, thank you so much for joining the show. This was one of the more interesting, deep dives into the finance side of Bitcoin mining. So I appreciate it. I think listeners will as well. Again, a lot of people listening to the show are working at Bitcoin mining companies trying to figure this out. So the perspective is really useful. But yeah, thanks for joining.
Thank you for having me. It's a pleasure.